afternoon, and thank you for joining us for an MP webinar covering the Employee Retention Credit, Funding for Businesses Impacted by COVID. I'm Katie Kreider, Marketing Specialist here at MP. For those of you joining us on a webinar for the first time, MP is a full-service human capital management company. We offer a complete suite of products and services to support organizations through the entire employee lifecycle, including recruiting, HR, payroll, benefits administration, time and attendance, and compliance assistance. We support our clients with cutting-edge technical solutions, as well as proactive, reliable service and deep HR and payroll expertise. At MP, we are wired for HR and help our clients succeed by aligning their people strategy with their business goals. I'm excited to introduce your presenter for today, Paul Carelis. Paul has over a decade of experience in the HR consulting space, working with businesses of all sizes and industries. Paul and his team of certified HR professionals at MP assist clients with training, compliance, and full circle HR guidance and support. Just a few housekeeping issues before we get started here today. If you would like to submit a question during the program, please use the Q&A feature at the bottom of the screen. We will be sending out the recording of the webinar later today, along with the slides. And with that, I'm going to hand the mic off to Paul.
Thanks so much, Caitlin. Welcome, everyone. If this is your first time to one of our webinars, we sincerely welcome you. If it isn't, we welcome you back. Really looking forward to digging into today's topic. It's one we've covered before, but we find more and more that businesses are realizing that they may be eligible for employee retention tax credits. It's something that was largely ignored for a while, and rightfully so. We'll talk about that, but it is something if you are part of a business that you want to make sure you're up to speed on, because you could potentially be leaving lots of dollars on the table if you don't explore your eligibility. So in terms of what we'll cover today is we'll discuss eligibility, help determine whether or not your business may be eligible. The rules for eligibility do differ between 2020 and 2021, so we'll go over those key differences. We'll go over some definitions so that we're all speaking the same language when it comes to these credits. We'll talk about some of the IRS guidance that's come out over the last several months. That's helped clarify some of the gray areas we were encountering early on with the program. We'll go over some frequently asked questions. We'll review some scenarios that we've run into over the last year and change that we've been doing this work, as well as some key facts and figures, and then also open it up to your questions. So as Caitlin mentioned, please do feel free to use the Q&A feature in Zoom. For those of you who sent some questions ahead of time at registration, those did get forwarded to me. We had over a dozen questions beforehand, so I'll make sure to get to those as well. I do have those here, but really looking to dig in, and please don't hesitate to add new questions as well. All right, so in terms of the history, where did this all come from? Why are we talking about it? And why are we talking about it now in 2022? The Employee Retention Tax Credit, or ERTC, or ERC, depending on who's saying it, was born out of the original stimulus bill back in, I believe, April of 2020. That being said, most businesses did not take advantage of it at that time because in the original stimulus bill, they created two programs, Employee Retention Tax Credits and Paycheck Protection Program loans. And the original bill stated that businesses had to choose one or the other. You either did a PPP loan or you did ERTC. You couldn't do both. So with that being said, most businesses went with the PPP, were able to get some much needed funding, support their businesses. Great program, as well as the second draw program in 2021. Also at that time, the ERTC was only available for calendar year 2020 and capped out at $5,000 in tax credits per employee. Fast forward to December of 2020 and the second stimulus bill that was passed. This one really flipped this whole program on its head. So the first thing that it did was it eliminated that disqualification for PPP borrowers. So as 2021 was kicking off, businesses now had the opportunity to take advantage of both. So they could having that first PPP loan did not disqualify them. They could still go for a second draw PPP loan and still work around those time periods and the payroll costs being paid with PPP funds, working around those dollars and those timelines to still also claim employee retention credits. It also created a program for 2021 and a more generous program as well. So generous in the sense that it was a separate program for each quarter of 2021 and also provided a higher credit amount. So we'll do a bit of a comparison in a second, but from a high level, the 2020 ERC program provided up to $5,000 per employee. The 2021 program provides up to $7,000 per employee per quarter. And this is good through the first 3 quarters of 2021. So if you combine 2020 and 2021, you could have a potential maximum retention credit coming your way of $26,000 per employee. They also changed the rules for eligibility at the time of the second stimulus bill for the 2021 program. So the 2020 eligibility rules remain the same. The 2021 program had a new set of rules. We'll discuss those in a second. And then finally, the American Rescue Plan, which was passed last year, middle of 2021, added some additional quarters to ERTC. So the second stimulus bill brought it into 2021 for quarters 1 and 2. ARPA created the program in quarters 3 and 4. The recent infrastructure bill did remove quarter 4. So as of this time, quarter 4 is not an eligible period for claiming employee retention credits. They did also create some new categories for eligibility. So the first of which is a severely distressed business. Those are very few and far between, luckily. It's usually as a result of revenues continuing to be 90% or more down when compared to 2019. So it'd have to be a business that was really continuing to be hard hit to qualify for that. On the other hand, a lot of businesses have been able to qualify as recovery startup businesses. So this is kind of a separate ERTC program open to businesses who started February 15th of 2020 or later, so they can have been in business before then, and who have $1 million or less in annualized gross receipts. Those businesses, and just for quarters 3 and quarter 4, so this is the one program that is open in quarter 4 of last year, they can get ERTC of up to $50,000 for their business, and they don't have to meet some of the other eligibility guidelines that we just discussed. So if you are a business who is new as of February of 2020, we'd be happy to discuss that with you offline. One thing that also came about as part of the ARPA when it came to these credits, the IRS, as you've probably heard, is kind of in a crisis mode. They're inundated. They've got millions of returns in backlog. So really, with this credit program, largely what they're doing, or at least what we've seen, is it's taking a while for them to process, but they are pretty much processing all of them and sending out the credits. But they are reserving the right to review and audit them. And through ARPA, they bought themselves basically a 5-year window for them to be able to review the returns and determine whether or not a business was truly eligible for ERC. So you do want to make sure that you are being cautious and compliant and ethical with your claims, because you will have a 5-year window where they can inspect that. ARPA also clarified some of the other restrictions besides PPP loans where you have to navigate around when it comes to claiming your credits. So in addition to PPP, again, it's not a complete disqualifier. You just have to make sure you're not double dipping at any given time. But you also have to factor in restaurant revitalization grant funds, as well as shuttered venue grants, and any of the federal COVID FMLA money that you may have received when people were out sick or quarantining or receiving vaccination. In terms of IRS guidance, so when this first really got big, so early 2021, when people realized, hey, I can take advantage of this now, even though I have or had a PPP loan, there was a lot of gray area. The original bill that introduced ERTC wasn't too rich with details in terms of some of the questions that were coming up for businesses, trying to determine whether or not they qualified, what time periods they qualified for, or even how to go about claiming the credit. So the IRS has done a pretty good job of releasing guidance, releasing some frequently asked questions, even entertaining some scenarios to give us a better handle on, when someone may or may not be eligible for credits. So the first of which was, there was kind of this vague definition, hey, you qualify if you had a decline in gross receipts, which we'll talk about in a moment, or if your business was fully or partially suspended due to COVID-19 regulation. So, there were tons and tons of questions. What qualifies as a suspension? Did I need to be forced closed, or was it a scenario where I had to have the doors locked and not be able to allow the public in to any extent? Very few businesses would qualify in that sense. Fortunately, they clarified that is not the case. Really, the measure of especially a partial suspension of operations has to do when there is a COVID-related restriction in place, and that restriction suspended or altered a function of your business, and the amount that it needed to kind of suspend or affect the business goes by this 10% rule. So if you look back at your 2019 revenues, whatever the piece was that was affected or suspended would have had to either make up 10% of the revenues of the business, or 10% of the hours worked should have been at that time dedicated to whatever this function is. So the cleanest example, or the most universal example I can think of, is with the restaurant. So in most cases, they were allowed to continue to have takeout and delivery. Some places could even have the dining room open with certain capacity. But just about every restaurant that did have dine-in service was restricted, in the sense that, and it depends on the state as well as the time frame, but they may have been able to have 25% of their normal capacity for dine-in, or 50% or 75%. Provided and assuming that the dine-in piece of the business accounted for more than 10% of their revenues or 10% of their staffing, that would qualify as a partial suspension of operations. So that's just one example. We'll go into some others later on this afternoon. IRS also did kind of clarify how to go about claiming the credits and how the money's going to come in. So it is a refundable credit. It's all based on payroll tax and Form 941 that's filed quarterly. So the way that businesses claim this credit, especially at this point, since all the quarters that were eligible have now passed, would be filing a 941X, which is an amendment to the original 941 that you, or most likely your payroll provider, filed on your behalf for the relevant quarter. So unfortunately, the IRS does not have a mechanism for electronically filing 941Xs, so these do have to be done on paper. And similarly, once the credit is issued, those are being mailed in the form of a paper check to the business. So you do want to make sure that in terms of your records with the IRS, that your address is up to date, because there have been instances where a business has had an outdated address on their tax returns, and the IRS has issued the check and sent it to the wrong place, and it seems like these are not being forwarded to new addresses. So they get rejected, sent back to the IRS, and then they just kind of sit on it until they hear from someone to correct the address. IRS has also subsequently clarified owner eligibility. So the general rule and the golden rule is, if there are any 51% or greater shareholders of a business, and if people are related, you kind of add up their percentages together. But if you have an owner or related owners who are 51% or more ownership stake in a business, they're excluded in terms of their wages from claiming credit, and their family members are also excluded for the credit. Aggregation rules are also important if someone owns multiple businesses. So if you are a control group, you do have to aggregate the business for in a few different ways. Some may hurt eligibility, some may help it. So the aggregation rules apply to gross receipts, So when you're figuring out whether you had a decline, if you're part of a controlled ownership group, you have to kind of combine all of the receipts across the businesses. You do also have to aggregate employee counts and full-time employee counts. So when determining the size of your business for this program, you do need to aggregate all the employees across all of the entities. And then finally, and what can sometimes be beneficial, is you can aggregate when it comes to restrictions. That same 10% rule applies, but in an instance where maybe you had 3 different Fed IDs, all with the same owner, let's just assume they all did the same level of business. If one of those businesses was subject to restrictions and the other 2 weren't, because that one business did account for more than 10% of the total revenues or total staffing, all 3 entities would be able to use the aggregation rules, and all 3 entities would be able to claim credits on all their employees. So it can help, as well as potentially hurt eligibility. They did also do some clarification in terms of governmental orders and what counts when it comes to restrictions. So it can't simply be, a governor or an attorney general kind of sharing their opinions or their thoughts in a press conference. It has to be some kind of formal declaration that something is being restricted, that there's a limitation, a formal limitation in some way. All right. So as I said, there are 2 pathways that a business can be eligible for the employee retention credits. So the first of which is that full or partial suspension that we talked about. And this is all kind of measured on a quarter-by-quarter basis. When it comes to the restrictions, you do kind of have to know what the restriction is. So you kind of have your paper trail and your evidence for why you were eligible, and the time period for that restriction. So today I'm sitting in Massachusetts, and here most of the restrictions were lifted as of May 29th. So in those scenarios, when we're working with a business that's located in Massachusetts, for instance, let's say they were a restaurant, once all those restrictions were lifted on May 29th, unless they qualify under the gross receipts decline, that's when the eligibility would stop. It wouldn't extend to the full second quarter. The eligibility would end May 29th, and they wouldn't be able to claim credit for wages paid after that date. The other avenue for eligibility is a decline in gross receipts. So when you're determining whether or not there was a decline, you're always comparing against 2019. Whether we're talking about 2020 or 2021 ERC, you're always comparing against 2019. That's your measuring stick. So for the receipts decline, if we're talking about the 2020 program, there needs to, in quarter by quarter, you need to show a 50% or greater decline in gross receipts compared to that same quarter in 2019. If you are eligible, again, the gross receipts decline does extend for an entire quarter, and then some, which we'll talk about in a second. Some other key differences when we're talking about receipts decline is that for the 2021 program, again, compared against 2019, you only need to show a 20% decline in gross receipts quarter by quarter. So a much easier bar to reach in many cases. Another really important note, as you'll see at the top of this graph here, is that in terms of eligibility, the definition is quite different from 2020 to 2021. So much like the gross receipts, you want to always use 2019 as your reference point, and this comes into play for determining whether or not you're a large employer as well. So what you want to look at is actually your full-time employee count, employees who worked 30 or more hours per week, and what that average was month by month for the calendar year 2019. That's going to be your magic number for the size of your business. Regardless of what happened during 2020 and 2021, your size is determined by your full-time employee count in 2019. This isn't like the Affordable Care Act where you have to count full-time equivalents. So if you say had 50 employees who worked 30 hours per week, and then you had 50 employees who work 15 hours per week, you don't have to count those 15-hour per week employees at all. There's no equivalency there. You can still claim credits on their hours, but in terms of determining size, you only have to count full-time employees. So in that scenario, their size would be 50 full-time employees. Now, whatever that number ends up being for your 2019 count, will determine your size. So for 2020, to be fully eligible for employee retention credits, provided you meet the other eligibility guidelines, you'd need to be at under 100 full-time employees in 2019. To be eligible in 2021, you just have to be under 500 full-time employees in 2019. So big difference there. And if you are determined to be a large employer, so meaning over those numbers that you see here, the restriction is that you can't claim credits on all of the hours that are worked by your workers. You would only be eligible to claim credits on wages that you paid to people who were not performing work. So this comes into play more into 2020 when there are sometimes furloughs and things like that. So if someone is determined large, let's say they had 200 full-time employees, if they did some furloughs and either paid some people some wages during that furlough time or kept them on the health insurance plan, the group health plan, the payments that they made towards the group health plan could potentially be eligible for employee retention credits. And then they could explore 2021 where things would really open up for them, provided they were under 500 employees. Then all the wages would potentially be eligible. You'll see a note about the preceding quarter rule. So this comes into play for the 2021 program. So when you're looking for that 20% or greater decline in gross receipts compared to 2019, to be eligible for a quarter, that quarter that you're trying to be eligible for, or the immediately preceding quarter needs to show that 20% decline in gross receipts. So what I mean by that is if you're looking to be eligible for quarter one of 2021, you need to show that either quarter one of 2021 was a 20% drop against quarter one of 2019, or that quarter four of 2020 was at least a 20% drop against quarter four of 2019. So, and that extends on. So for quarter two eligibility, you can either look at Q2 or Q1, and for quarter three 2021 eligibility, you can either look for a decline in quarter three or quarter two. And what we found in many cases is that businesses were still under restriction. They were still facing declines in quarter two of 2021. But then once restrictions were lifted in quarter three, they did not have that decline. But because they can lean on Q2, as long as their quarter two is down 20% or more, they're automatically eligible for all of quarter three. So some key definitions we just want to be clear on before we move ahead. The eligible wage period that you could potentially claim credits for any quarters that were eligible would be from March 13th until September 30th of 2021. So March 13th, 2020 through September 30th of 2021. Qualified wages is pretty open-ended in terms of you can count salaries, commissions, tips, really any similar compensation that's subject to FICA tax, Social Security, and Medicare. Now, when you're determining your decline in gross receipts, you kind of have to include everything: total sales, any amounts received for services, interest, dividends, rents, royalties, annuities, grants, donations for nonprofits especially. All of that stuff goes into the factor for determining gross receipts. So for 2021, we talked about the preceding quarter rule. Works a little bit differently for 2020. You're looking at the actual quarter, and again, needing to show a 50% or greater decline. But once you have a quarter that qualifies under that definition, you continue to be eligible in subsequent quarters in 2020 until you have a quarter where the decline was less than 20%. You'd still be eligible in that quarter, but the following quarter would lose its eligibility. So what I mean by that is, in this example, let's say this business had a 52% decline in Q2 of 2020, so they qualify for Q2. But then in Q3, things shot up. They were only down 17% in Q3. Under the rules for 2020, they would still be eligible in that quarter. It's just the quarter following that, so in this instance, Q4 would not be eligible. All right, so I'll take a quick look at the questions before we enter the FAQs. Okay, question. Does our payroll company file Form 941 Do we receive the check from the IRS, or our payroll company will let us know if we are eligible for the credit and we need to apply by ourselves? Good question. So if you use a payroll company and they're submitting and filing your taxes for you and issuing your W-2s and all that fun stuff, then yes, they're filing the 941. Because of the pathways to eligibility, your payroll company wouldn't necessarily know on their own whether or not you're eligible for the credits. They don't know your gross receipts information. They don't necessarily know what restrictions you may have been subject to. So you would need to engage with someone educated in tax credits to determine your eligibility, and then also to calculate the credits to claim. Then once you have your credit amounts, it'd be broken up by quarter. You would then go back to your payroll company and let them know, hey, payroll company, I need to amend my return to claim employee retention credits. And then if you're working with us or someone else to determine those credits, we would provide you with all the information you need to submit to your payroll provider so that they can amend those returns on your behalf. Once those have been submitted, you would receive the check in the mail. It would come to your business. It wouldn't go to the payroll company. You mentioned PPP funds and other federal funds that payroll must be reduced by. What about other grants? So really, the magic thing you want to look for, and even when we talk about PPP or restaurant revitalization or all those other programs, you don't necessarily need to fully exclude those. And each program is different in terms of their requirements and what you need to spend the money on. Some are very specific. The PPP had pretty strict definitions. You need to spend at least 60% on payroll. And then there are other eligible expenses. You can't just spend it on whatever you want. That being said, you only need to exclude grant money that you funded payroll with. So let's say you got a restaurant revitalization fund grant, for instance, in quarter 2. If you have a lot of time to use those ones, especially, I think you have through 2023 to use RRF funds. But if you use those on capital expenditures, let's say kitchen equipment or rent or utilities or anything else that wasn't payroll, you don't have to exclude those dollars from your ERTC calculations. It's strictly when we talk about PPP, especially where 60% of those do have to be used on payroll costs, that at a bare minimum is what you need to exclude. If you used 100% of your PPP loan on payroll, then yeah, we're going to have to exclude the entire amount. But whatever, in terms of your forgiveness application, whatever you listed for payroll costs is what we need to exclude. The grants themselves don't exclude. It's just a matter of what was actually spent on payroll, just so you avoid getting a credit on any payroll that you paid with some of these funds. Is there a tax liability attached to receipt of an ERTC? Yes. So the one potential downside to ERTC, especially because it can be a lot of money, sometimes thousands, sometimes over $1 million in certain instances, is that it is considered taxable income for the business, and it's considered taxable based on the quarter that you're claiming the credit on. So even if you're claiming it now, if you're claiming for, let's say, Q3 of 2020, at least as far as the current guidance goes, that credit is considered taxable income for Q3 of 2020. Great question here about gross receipts. Do PPP loans count towards the gross receipts calculation? No, they don't. So there was a lot of question about that. Initially, that wasn't originally in any guidance, but the IRS did clarify and made a safe harbor so that if you did receive a PPP loan, you do not have to count that money towards your gross receipts calculation when measuring whether or not there was a decline. All right, we qualified. Q2 did not have a decline, but we then had a 20% decline in Q3 of 2021. Do we qualify for that quarter? Yes. So as long as you can find a quarter of eligibility, you can claim that even if you're not eligible in previous quarters. Yeah, so that does come up from time to time and quite often, where there may be 1 or 2 quarters out there that for any number of reasons did suffer a decline, and you can apply for those quarters. It's great if it's a quarter prior to quarter 3, because then again, with the preceding quarter rule, that essentially gives you 2 quarters of eligibility, but 1 quarter is better than none. All right. We participated in PPP loans in 2020. Are we eligible for credits in 2020? Yes. Yeah. It's just a matter of factoring in your PPP loan. How much of it did you use on payroll costs? Excluding that from the wages you paid in 2020 and working around that to determine what credits may be available to you. How is the IRS notifying employers of the issuance of the paper check? It's been 8 months since we've applied. So yeah, unfortunately there are folks that have been waiting quite a while. Some of them have come back as quickly as 4 or 5 months. IRS originally said it shouldn't be longer than 7 months, but we are seeing some returns extending and going beyond that point. In terms of how to answer your question, you're going to want to request, or if you use a payroll provider who's filing your taxes on your behalf, have them request an IRS transcript for the quarter that the ERTC applies to. That transcript will first confirm that the IRS received the amended return. It'll show what date they kind of filed it. It won't. That doesn't mean that they necessarily started to work on it, but they entered it into their system and assigned it to somebody. And that date just really confirms that they've received it. It can, again, be several months after that date before you see something. But when the credit is issued, it will update the transcript to show that a credit has been issued. There'll be a date associated with that. And then generally within 3 to 7 business days from that date on the transcript of when they've issued the credit is when you should expect to see that in the mail. Is the 3/13/2020 to 9/30/2021 eligible period based on wages paid or wages earned? So you generally want to use the IRS constructive receipt theory, which basically says when they were paid. So when they were constructively received, meaning the check dates when they were paid. How long does it take to send the check? So again, for people who jumped on this in the quarters that they were active in and were able to get the credit on the 941 when it was being filed regularly, those were pretty quick. But again, everything now is on amended returns, and it's generally taking, I'd say, several months, anywhere from 4 months to 7 months plus. Have you seen companies analyze suspension of operations related to sales across state lines in multiple jurisdictions? For example, selling to schools or restaurants in 50 states. Is this kind of research a non-starter in my observation? Not necessarily. Again, we're anticipating some level of scrutiny on this down the road. So what you would really want to do if you were going to approach it from that method would really be get all your ducks in a row. Be able to show, state by state what the restriction was, what the dates of the restriction were. And then on top of that, be able to show that in 2019, at least 10% of your revenues or 10% of your staffing was derived from those places where you were restricted and claiming eligibility for. There are some questions in here about on like corporate returns and forms 990 for nonprofits in terms of how to record the payment. I will have to defer to your accountant or CPA on those. I don't want to misjudge or provide any legal or financial advice in terms of tax filings. I'll leave that part to the filing experts. If it was not a government restriction, but you had people out due to COVID and still paid them in 2021, does that count for the credit? It wouldn't count for employee retention credits. It would potentially qualify for some of the COVID sick leaves that were available at the time. So hopefully you took advantage of the ARPA sick leave and the FFCRA COVID sick leave to pay those people while they were out with COVID. Okay, and someone just wanted me to clarify what to ask the payroll provider for to confirm receipt. So you want to get a IRS transcript of your 941 for whatever quarters you filed the ERTC in. So if you claimed employee retention credits in Q3 and Q4 of 2020 and Q1 of 2021, you want them to request a transcript for each of those quarters for the 941. And they're not the easiest thing in the world to read, but if you kind of go line by line, you should see a line, some weeks after the company filed that return for you. Again, it went through the mail, so it wouldn't have been instantaneous, but let's say you applied for these all in February of last year. You should see a line item probably dated sometime in March that says amended return filed. And again, that just means that they received it and assigned it out. So that's what you want to look for on the transcript. If OSHA restricted access, what kind of impact would that have? That could potentially qualify. It's all about the narrative and being able to feel confident and certain that whatever that impact was, that it prevented your operation. So we'll go over a couple scenarios in a minute as time allows, but I know one of the ones that the IRS used that I thought has come in handy a little bit was they talked about a grocery store, and they said, there was a grocery store, and because of some local regulations, and these COVID restrictions, they can be federal level, state level, or city or local level too. But in this city, in the example, the grocery store was forced to shut down their salad bar. So, there was an impact, that was a restriction, but when push comes to shove, that salad bar did not account for 10% of the company's gross receipts. So that was not considered substantial enough to be a partial suspension of operations. Now, if, there are other scenarios that within that grocery store that could potentially qualify, but it's all a matter of what was the impact of that restriction on your business. Were you still able to get the job done or not? And we'll go over some scenarios in just 1 minute. So some other frequently asked questions that come up, and I will also get to the questions that came in prior to the webinar. Are there any plans to automate Form 941? There have been several requests, businesses, business groups, accounting firms, all of that. Unfortunately, no. The credits, and especially the modification of the credits that allowed so many more businesses to apply, really caught the IRS off guard as well, and they did not have the software built or optimized to be able to handle all of the requests that were coming in. So it is all paper as of right now. The good news is that they originally had all of the ERTC returns going to one single IRS office. I want to say maybe in Cincinnati, but they do now have them being serviced by multiple branches. So they're trying to get better, but they're certainly struggling to keep up with the volume. Another question that we get: does an employer need to prove that a significant decline in gross receipts is related to COVID-19? The answer to that is no. So I can think of a group I worked with where they had owned 3 restaurants, and they sold one of the restaurants in 2020. So when you look and compare to 2019, when they had 3 restaurants, versus 2020 and 2021 when they only had 2 restaurants under that ID, there's kind of naturally a decline in gross receipts. And I'm sure they were impacted by COVID-19 as well, but there's no need under the gross receipts eligibility to have any tie into COVID-19 necessarily. Okay, so we went over this a little bit before, but it's worth repeating. In terms of determining your size and your employee count for eligibility as a small employer for ERTC, you want to look at 2019, look at every employee who averaged 30 hours per week or 130 hours per month for each month, and then once you have your 12 monthly totals of full-time employee counts, divide that by 12. A question that comes up often, and this is a great problem to have: what if my tax credit exceeds what my tax liabilities were in that quarter? So let's say your payroll tax liabilities were $50,000 in quarter 3, but you're showing a $500,000 credit for Q3. This is a fully refundable credit, so you will get all that money back in the form of a check. It does not have to meet or be under what your actual tax liabilities were. All right, so again, I think we've defined this. It's just important that if you do have some gray area, you're not qualifying under gross receipts, you do really just want to scrutinize that interruption to your business to make sure it qualifies. We do have some decision trees available for anyone interested. If you want to kind of go through your own individual scenario, we'd be happy to share these with you. We can send them out later today. But in terms of determining whether or not the suspension of operations has occurred, I wanted to just kind of share 5 or 6 examples to hopefully help you in case this may be a situation you're facing. So the first scenario is a nonprofit that provides educational services in the community. So in this example, this nonprofit was able to transfer some of their services remotely, do some tutoring, some reading assistance and things like that, but other programs, some physical education activities, after school care, all of that were mandated closed or restricted because of COVID-19. In this case, this would count as a full or partial suspension, provided that more than 10%, the programs that were affected accounted for more than 10% of revenues or of staffing. Fast forward to a tech company. So tech company had some remote workers. It did also have a large in-office staff as well. But because of COVID restrictions, all of the office staff were required to work remotely. They could not work in the office. But being a tech company, all the employees were able to do their jobs. There was very minimal impact on the business operations. They were restricted that they couldn't be in person. But the IRS guidance to date has been that if that the business was able to largely continue as is through remote work and telework, that would not count as a suspension of operations. Let's next go over a brewery. So this brewery has 3 different production facilities in 3 different states. Of those 3, 1 location had a tap room. That tap room was closed because of COVID restrictions. People were not allowed to consume alcohol on premises because of COVID restriction through Q2 of 2021. Because they're largely production, their gross receipts actually increased. They did not have any quarters of decline. Good for them. In this instance, provided that that tap room accounted for at least 10% of staff or 10% of revenues for all of the breweries, when combining revenues there, they would still qualify and be able to apply the credit to all workers in all of the locations because the business overall had that partial suspension of operations. All right, let's talk about next some controlled ownership scenarios. So you do want to be mindful when you do have a control group. So in our example here, there's a husband and wife. They fully own 2 businesses, one being an auto body shop and the other being a restaurant. The auto body shop accounts for 70% of the revenues of the business. They were considered essential. They didn't have anything that would qualify as a restriction or a suspension of operations. And their gross receipts were also steady. Because the restaurant accounted for 30% of revenues, all of those restrictions that applied to the restaurant, because of the aggregation rules and because they're a controlled ownership group, they'd be able to claim credit on the auto body shop wages as well, because part of that entity was, and a sufficient part of the entity was subject to restriction. In terms of ownership share and ownership eligibility, a scenario where there's a gym, 3 college friends unrelated to one another each own 1/3 of the fitness center, and they're all on the payroll as W-2 employees. In this scenario, because they're not related and none of them own 51% or more of the business, their wages would be eligible for employee retention credits. Let's say it was, different. Let's say 2 of those college friends were married. So they own 66%. The one owner who owns 1/3 and isn't related to the other 2, their wages would be eligible, but the husband and wife that own 66%, their wages would be excluded, and then any family members that they have on the payroll that they are paying as employees, their wages would also be excluded. And then finally, let's talk about a museum scenario. So a museum, was able to stay afloat and not suffer declines because they had some great fundraising. They had some very generous contributors and people who donated to keep the gross receipts decline. So they were fine. They were not eligible by gross receipts. They were eligible because of restrictions throughout 2020 and into 2021. Fast forward to 2021, they were able to reopen in June, but the donations dried up. People were still afraid to go to the museum, so their gross receipts fell off in Q2 and Q3. In this scenario, they can kind of mix and match. So qualify based on gross receipts through Q2 of 2021, and then also be eligible because of restrictions in following quarters. All right, so before I dig into the final set of questions here, I did just kind of leave everyone with some takeaways. So some things you want to make sure you're familiar with before you pursue your employee retention credits. First, understand the differences between the 2020 and 2021 programs. 2, make sure you're familiar with how to calculate your size and what that means. So even if that number comes up over 100, yeah, that'll affect your eligibility for 2020. But as long as you're under 500, you can still be fully eligible for 2021 potentially. Do you understand how to determine gross receipts so you have a good understanding whether or not there was a decline? Have an understanding for whether or not the effects that COVID and COVID regulations had on your business may qualify as a suspension of operations. Do you want to be familiar with the limitations on owner income if it's a 51% or greater owner? If you're in a controlled ownership scenario, you need to make sure you're aggregating in all areas that you need to. You really want to master maximizing around a PPP loan. So you can pull wages before the PPP as well as after it. There's a little bit of magic to that. It's something that we do and specialize in, but you just want to make sure you don't leave any credits on the table. Do also make sure you're keeping very good records and files when it comes to all of this. So for clients we work with, we provide a substantiation document that details, what the method of eligibility was, what the time period was, and what the credits were and how they were calculated. You want to keep something similar if you're doing this elsewhere or on your own. And we do recommend being pretty specific about the restrictions, what the restriction was, who the governing body was that was issuing the restriction, and what the time frame was for that restriction. Number 9, please note this isn't too good to be true, and really these numbers add up really fast. So you can have a company with 20 or 25 employees that can qualify for hundreds of thousands of dollars in credits, and they're very valid and very real. And then finally, just do exercise some patience. I know a lot of businesses could really use a financial shot in the arm and could really use this funding. The one thing I can say is just get it out, get it filed as soon as you can to get the clock started with the IRS. Also, if you've jumped around from payroll systems, it's good to get it done sooner rather than later, because sometimes some of that finer paycheck by paycheck employee wage data can get lost along the way. So do jump on this as soon as possible. You do have up to 3 years after the due date for whatever quarter 941 you're going to be amending. So there is still some time, but again, you do want to get your request in as soon as possible to get the funds as soon as possible. So I did just want to address a few more questions before we run out of time here. Majority of our gross receipts come from contracts with schools who are shut down. Does this qualify even though my business itself was not required to shut down? Yeah, potentially. So, whether you're construction or whatever you are, if the place where you do business, if you weren't able to do business the way that you do, whether or not that's on your own property or, in whatever your business specializes in, that could potentially be an avenue for eligibility, yes. Is this credit still available if we've already filed our 2021 taxes? Yes. Yep. So again, if you're filing, let's say for 2021, you have up until 3 years after that original 941 was due to file. So you can definitely still amend your returns. We're a small startup with only 1 paid employee, 4 partners. Profitability was impacted. Are we eligible for funds to offset our costs. Yes, I mean, it would be limited to that one employee, so ERTC probably wouldn't be the most advantageous or most fruitful source of money for you, but definitely look at other programs. We did a little while back do a webinar with the Small Business Administration. There should be a recording of that available via our website, so do look into that and to some potential other programs that may be available for you. The ERTC is restricted and only eligible on employees who received eligible wages. So partners, independent contractors, monies paid to those folks would not be eligible wages for this program. We have over 400 employees and received a PPP loan that was forgiven. What are our eligibility restrictions? So assuming you're talking about 2019 employee count and assuming at least 100 of those employees were full-time, most likely would have pretty limited eligibility in 2020. But you are well under the threshold for 2021. So just working around your second drop PPP in 2021, if you're otherwise eligible based on restrictions or gross receipts, you could have a very healthy credit coming your way. Let's see, try to do one more. We received 2 PPP loans. We did not qualify based on gross receipts. Our business was not shut down during COVID-19. We're unclear if we may be eligible based on business disruption or other qualifying criteria. So, it's hard to say without knowing the business or the industry or what the restrictions that hampered your operations were. But we'd be happy to talk to you. This is a service that we provide for businesses. Whether or not you use us for payroll, you can use us for employee retention credits, and there is no obligation for the consultation and the eligibility determination. We don't charge anything until you've received your credit. So can't hurt to give us a shout, and we'd be happy to talk through it with you. So it looks like those are the questions we can get to at the moment. Again, happy to answer any more offline if you have a specific scenario that you'd like to discuss with one of our professionals here on the team. We'd be happy to do it. But other than that, I will hand things back over to Caitlin to close us out for today. Thank you so much.
Thank you, Paul. Lots of valuable information on a complex topic. Any questions that were not able to be answered on today's program will receive a response via email within 5 to 7 business days. The MPHR team is here to help guide your organization on any HR compliance issues. If you would like to learn more about how we can assist your organization, please visit our website to set up a short 15-minute call. Be sure to join us next week on the same day and time for our webinar on 2022 recruiting best practices to land top talent now. Visit our website to register and to see the full calendar of upcoming events and available resources. We will be sending out a recording of today's webinar with the presentation slides this afternoon. Thanks for joining and have a terrific day.